Good afternoon, everyone, and welcome to this first workshop about the underestimated challenge for risk manager, risk and insurance communication in a hardening market. Before moving to our session and introducing our speaker, let me just summarize a bit of housekeeping rules. So please, you can send us question during the entire session using the chat and the question tool, and we will answer and discuss these questions during the Q&A after the speeches. And after the various presentation, we will have polling questions. So you will have questions with some choices. So please vote during this session, because that will also be an interesting tool for us to move the discussion forward. So before moving to our session, let me please introduce you our valuable speaker for today. So first, we have Alessandro De Felice. Alessandro is the Chief Risk Officer of Prysmian Group, which is an Italian multinational organization manufacturing electric power transmission and telecommunication cable. This is the largest manufacturer of cables in terms of revenue, with more or less 11.5 billion, and they have a global footprint. Alessandro is also the president of ANRA, the Italian Risk Management Association, and also a teacher for multiple risk management courses in various Italian universities and schools. So welcome, Alessandro, and thank you for being with us. We have then the pleasure to have Kerry Balethiran with us. Kerry is a group manager, business risk consulting for EMEA within FM Global, the well-known global mutual insurance company. Kerry has a very diverse background, as he held various positions during his career. He has been a spacecraft operation engineer for Airbus Defence and Space, a chartered accountant, and he has also been involved in the field of internal audit, treasury, and financial reporting. In his current position, Kerry is able to leverage this diverse expertise and experience to help FM clients throughout their full risk management value chain, from risk identification to exposure quantification, as well as from risk mitigation action to business continuity strategy. So we are really happy to have Kerry with us, and we hope that we will benefit from his interesting insights. And last but not least, we have with us Michael Samanas. Michael is the group CFO of Sigma, the leading steel service center in Greece, and beyond his CFO duties, he also oversees the M&A activities of the organization, as well as a restructuring plan of the group's debt with the major Greek banks. And last but not least, he is a board member of HARIMA, the Hellenic Association of Risk Managers, who recently joined FIRMA as the 22nd association in our federation. As such, it's really a personal pleasure to get Michael as a speaker today, as it is our first official opportunity to warmly welcome our Greek colleagues to the global FIRMA community. So thank you, gentlemen, for being with us. And if you allow me to give you a bit of an introduction for our topic today, for those who have attended the plenary session this morning, you have now understood, but I believe it was a surprise for anyone, that our industry is facing what we call a hardening insurance market. And one of the impacts for risk and insurance manager is that it is changing the way we have to communicate internally. Basically, the speech around premium, I would say, is not enough anymore, as we have to really dig into the details of uninsured exposure, reduction in capacity, exclusion, and how to structure our insurance program. So basically, we are facing more challenging questions from the very top of our companies. And we really have to demonstrate the added value of the insurance product and the consequences of the hardening market. What does it mean to have an insured exposure? What is the potential impact on the financials of the companies? And if you think about it also, the vast majority of us have now to face 15 minutes presentation to the top management instead of 5 minutes before. So it is really changing the way we have to communicate. So the skill set for insurance and risk manager in how to communicate is more important than before. And I would say it's not only about what we communicate. It's not about the technicalities of our business. It's really about how we communicate. Because of course, communicating to the top management of our organization is as a specific language, and we have to adapt to that. So making a long story short, I would say the hardening market is pushing your communication to slightly change. And you need to be, let's say, more impactful. And the question will be, how can we do that? And that is what we are going to discuss with our panelists today, and mainly around three main questions. First one would be, what are the general tips and tricks to better communicate to executive? The second one will be around, how can you speak about insurance and risk to top executive? And the third topic will be, what a CFO is expecting to receive as information. So now, leaving the ground to our speaker, I would like to start with Alessandro, asking you, Alessandro, you are a chief risk officer, and as such, you are an executive within your company. How would you advise the audience about the specific way of communicating to an executive committee, and maybe detail a bit, what they expect to hear? How do you structure your speech to an executive committee, and how do you basically talk about risk to top senior management?
Thank you, Laurent. Good afternoon, dear friends and colleagues. And thank you for your question, Laurent. Yes, let's first of all start from where a chief risk officer is reporting to, with different kind of people. On the average, it's very common that companies organized with an enterprise risk management framework are organizing a committee within the board of director, and typically a committee of top managers. So these two committees has different rules and typically receive different or let's say a similar reporting, but with a different goals and outcome. Let's start from the board of director, or a board formed within the board of director to control risk in general. So typically the role of a board is a role of controlling, be sure that the policy that has been declined in the company is enhanced, that the right commitment is followed by the management, and in principle they are liable and responsible towards all the stakeholders. So their role is a role that is starting from a point of view that they feel themselves responsible, that the right thing has been done, and in this way we need to communicate to them in a very, I would say, easy way, because sometimes you may have members of the committee or members of the board that are not particularly experienced or don't know in details the methodologies and the wording of the enterprise risk management. So never take things for assumed, and always be ready to have a clear and fast explanation on what you are referring to. For example, if you are reporting the quantification and analysis of risks and the potential impact on economical figures like EBITDA, net financial position, stakes values in the market, things like that. You have always to be very clear and very in deep in explaining what have been the assumption that has been done and what kind of methodology has been followed. With the difference with an internal top management committee is that the top management is more keen in getting insight and explanation about the metrics and the volatility of the performance. So what are really the impact that may jeopardize the expected results, and what is the return of a mitigation of risks. And for example, another example, if we are talking about a very let's say easy risks, let's say a property risk, property business interruption risks, and we are requiring a budget for a mitigation action such as the installation of a sprinkler system in a factory, for example, we have to return the value of this investment, and the only way to let them understand very well what is the return of the investment is to for example, present the maximum foreseeable loss before the mitigation action has been implemented, and what will be after the implementation of the mitigation action. So going much more in numerical example and in economical metrics. Another important point is with the top management of the company is the alignment with the policy in terms of enterprise risk management, the alignment with the enterprise risk management framework. For example, how much, for example, we are acting in a coherent way with the risk appetite framework and the risk capacity. What are the deviation from this framework? If we go back to the board of directors, the board of directors needs to get a coherent representations of risks. For example, it happens that in particular, since the companies are issuing the non-financial disclosure, so related to sustainability, it happens that there may be no coherency between the enterprise risk management risks represented and the sustainability risks represented. It might be that the typical ERM risks are more quantitative and the sustainability risks are more qualitative. So this is a gap that needs to be resolved, and in particular also the last rules and the reference like the TCFD are declining requirements for company to going more on a quantitative analysis about, for example, the impact of climate change, sea rise level, and other natural events on the long period. This is more difficult back with the top management, because being the perspective, the horizon of sustainability risks very long in the time, sometimes we are talking about effect in 50 years, for example, or 20 years, or even 100 years, they feel less important to approve the necessary budgets required to facing these risks and to do concrete initiatives on these risks. So in this respect, I'm always a fan of a strict collaboration between the risk management functions with the audit and compliance functions, because in particular for those risks where the immediate effect of the mitigation action is not so easy perceivable, is important that the three functions are cooperating together, again, to come back to the principle of coherency with risk appetite, risk tolerance, and alignment with the risk management strategy.
Alessandro, may I ask you, I know from many of your speeches and discussions we've had that you always, speak about avoiding that, risk management and risk reporting is not just a let's say a tick the box exercise, and that we should always have a communication that is around actionable output, meaning that we come, of course, with reporting, but also about practical solution and action plan. Can you maybe expand a bit about that?
Yeah, this is the most important part of our job. I do believe we have to clearly represent that any activities, any mitigation, any investment, any assessment that we do on risks is aligned with the strategy. So why I'm saying it's not a thick box exercise. One thing is that a yearly plan, for example, on major on top risks analysis and major mitigation action and controlling system and KNI reporting is made in coherency with the strategy. Therefore, the alignment of the business plan, the 3 years industrial plan or the yearly management plan with the risks that are facing this plan. So, in other words, how we can measure if certain targets are achievable because the risks that are on top of this target. It could be also going in an area where the metrics of the business are very relevant. For example, how much a business case is sustainable because risks. What we can do in terms of analysis, for example, the typical Monte Carlo analysis scenario, where we can produce a number of situation, a number of variables. They may interfere with the budget and checking if that budget is sustainable under the risks, or what is the volatility of that budget. A speculative volatility, because it could be too much precautionary budget or too much aggressive budget. So the usual old sentence: if we are taking too much or not too many risks, because if we are taking too much risk, we are living in a very risky way, or if we are not taking enough risk, we are losing opportunities. So I think the perception that this exercise is done to support the business, to better take the opportunities, and to better stabilize the expected results, it's a very, very interesting argument for the top management of the company. Again, if we report then these methodologies to the board of director, we need to be able to translate in simple words, in plain text, what have been the methodologies on background, because typically in a board meeting or in a risk and control meeting, we don't have enough time to go in deep point by point. So we have to focus on the main understandable issues in a simple and quantifiable way.
Thank you, Alessandro. Thank you very much. Now, I believe, we understand how an impactful communication to executive and board member should be structured and what it should focus on. So now I would like to turn to Kerry and ask him, can you tell us a bit more about how these, let's say, overall principle should be applied when it comes to risk and insurance communication, and especially, of course, in line with what we were mentioning in the introduction, that the hardening insurance market is making this discussion a bit more, let's say, tricky or difficult.
Oh, thanks, Laurent. As Alessandro was saying just now, it's the role of the board to monitor and control risk. So communicating that risk to the board is essential so that they can feel that they have the information in order to address that risk. So what we've seen at FM Global with our clients is that those clients that have addressed deficiencies in their operations, when the worst case happens, if the worst case happens, they're much more likely to bounce back quickly. Their business is much more resilient. And a good example was the hurricanes in 2017, Harvey, Irma, and Maria, where our clients saw losses less than half of the industry cat model losses. So investment in risk management and risk improvement certainly works. So in order for the board to make those decisions about investing, the first thing they need to do is fully understand the exposure. What is the vulnerability that exists within the operations? And that's where insurance companies can help with engineering site visits. The engineering site visits are an extension of the eyes and ears of the risk manager, can highlight those deficiencies in the operations around the world and flag those up to the risk manager so that they can decide which ones to address. But it's important to have some method of ranking or rating those risks so that the risks that really are urgent for the board to address, the risk manager knows which ones those are and can flag them up the chain to the board. What we've seen with losses that our clients have had at FM Global is that these losses have generally resulted as a result of a deficiency that has already been identified and is well known, but it hasn't been addressed because it wasn't a priority of the board. And the reason for that is because nowadays more than ever, cash is a scarce resource, and in order for the board to prioritize where to spend that money, it goes to the places where it's the greatest, the most deserving. So this kind of return on investment analysis that Alessandro mentioned, that is key in terms of communicating with the board so that they have the right information in order to make those decisions. So as well as understanding the vulnerability, the other key area is fully quantifying the exposure. And Alessandro touched upon that as well, that within the insurance calculations, insurers will work on the property damage and the business interruption potential for loss during the exposure period. But the board needs to understand that insurance alone is not enough. Swiss Re have been monitoring large-scale losses since the 70s, and the key conclusion is that the uninsured element of the total economic loss exceeds the portion covered by insurance, and it's growing. So about 65% of losses are uninsured because they're not covered by the insurance policy, or they're not covered, or they exceed the indemnity period. The losses extend beyond the indemnity period. So when we're quantifying the losses and communicating that with the board, it is important to understand the traditional sort of insurable loss calculation, the property damage, the business interruption. But it's also important to understand that there are potential impacts that go beyond the insurance coverage period. So we illustrate that with the iceberg, these things that are below the waterline and can't be seen. But if you have a loss, they can significantly impact the valuation of the company. So losing customers, losing your existing customers and losing market share, that's obviously one of the key ones. But the impact on the company to grow the business, that's a more difficult one to calculate, but it does need to be calculated and used in the return on investment calculation, because with a smaller market share, obviously you've got less customers to sell to and to grow your business. But also with the distraction of implementing business continuity plans, rebuilding a facility, obviously management attention is distracted from the strategic plan, the 3-year plan, as Alessandro said, and so inevitably growth plans could suffer. And then the last area is investor sentiment. So a loss, a disruption is by definition an unexpected event. It's a profit warning. So investors will reappraise the circumstances that led to the loss, should the board have managed that risk better. Also the ability of the company to respond to the loss and bounce back, and that will influence how risky they see their investment in that company and what's called the equity risk premium. So they may decide that they're prepared to pay less. So that needs to be factored into the business case for resilience. And aligned with that is the cost of capital. If things go really bad, a disruption can drive up the cost of capital, which could threaten the viability of some of these new projects and potentially threaten the plans of the board. So it's very important to use the language of the board, bridge the gap between risk management actions and the strategic objectives of the company. The board of directors, as we just said, are there to manage and control the risk. It's their job to address the risk if it's presented to them in the correct way. So they've got a duty of care, a fiduciary duty to look after the assets of their shareholders and manage those in the best way. So if the risk is presented in the right way, they'll be compelled to address it. So we don't want the board to say, this won't happen, it's unlikely to happen. We need to present that information in terms of likelihood. We don't want them to say, we don't need to worry about this risk, it's covered by insurance. So the risk manager needs to communicate the broader impact on the business, grab the board's attention and compel them to act. And in terms of this hardening market and the way that insurance companies can add value to the process, it's about not just relying on insurance in the event of a loss, but preventing the loss from happening in the first place. And that's where insurance companies can add a lot of value to the risk manager and ultimately the client. I mentioned site visits and being an extension of the risk management function and eyes and ears on the ground. But also insurance companies can provide facts and figures, as Alessandro said, some quantitative measures around losses in your industry to further back up that business case in terms of this is what other sort of competing companies have seen in your industry in terms of losses, and you don't want to suffer that same fate. So there's a lot of facts and figures that insurance companies can bring to tailor that communication to your board. Also, the insurance company can help you with the communication around some of the financial KPIs that may be impacted, things like revenue and profitability, profit growth, earnings per share, the impact on cash flow, dividends, because the board will have made certain forward-looking statements to investors, and that's what the 3-5 year plans are based on. That's what the company's KPIs will be based on delivering. So your insurance company can help you in terms of tailoring that message around those strategic plans. But also, you mustn't forget non-financial KPIs, growing market share, customer satisfaction, order fulfillment times, or brand loyalty. All of those things can be brought into the business case too. But the key message is recovering from a disruption distracts management's attention away from running their business and growing their business. And insurance companies can help risk management functions and the board by understanding those deficiencies and monitoring them on an ongoing basis as the operations change, and ultimately helping the company address those deficiencies, make the company more resilient, and be a better risk. And in this hardening market, if you're a better risk, that will help in terms of accessing capacity and coverage, and it's in everybody's interest.
Thank you, Kerry. But we have a couple of questions, coming from the audience, and I take that opportunity to already take one of these questions, and it's which kind of metrics should be submitted to the board to make a point. And I believe it's interesting because you have just mentioned a couple of or a few of these metrics, be it EBITDA, free cash flow, and whatever it would be. What I would tend to say is that the insurance manager would first have to let's say to make his homework, because each company is different, and of course you need to be 100% sure that you understand what are the key metrics for your company. For some, it's EBITDA. For some of them, it's free cash flow. It could be the debt. I mean, if you have to target a lower level of debt, and there is, I would tend to say there is no one single answer, and that first you need to be sure that you translate correctly the risk in insurance matters into these metrics. But Kerry, I would like to ask you if you share that opinion, of course, and if you have anything to add.
I think you're absolutely right that the specific KPIs depend on the actual company, but there are some broad ones which will be uniform to all. You just mentioned cash flow. Cash flow is key in terms of the healthy running of a business, and revenue growth as well. Revenue growth is an important one that investors will use to determine the valuation of a company. So revenue growth, profitability, cash flow, those three ultimately underpin the valuation of the company, so the enterprise value of the company. So a disruption, regardless of KPIs, will ultimately feed into some of those profitability metrics, all the balance sheets, and impact the valuation of the company. But so I agree with you on identifying what it is very important to the board from the KPIs, but there are some sort of common financial KPIs, revenue, profitability, cash flow, that will be common to all companies.
And you also have, I would say, to just to add to what you said, that you need also to understand what is the impact of something that insurance could cover. I always take the simplistic but stupid example about a PDBI claim. And if your company has as a key metric EBITDA, and it's a very common one, I would say the PD part of the claim is not impacting EBITDA; it's an extra capex. But BI is impacting EBITDA. So depending on the KPIs, that was the point about fully understanding what does it mean, what the insurance cover is protecting in the financials of your company.
Great.
Thank you, Kerry. So now that I would say we know a bit better about how to communicate effectively to executive, and how we should structure our risk and insurance speech, I would say it would be interesting to get the view of an actual CFO, and we are lucky to have one with us today. So Michael, if I can turn to you and ask you, as a CFO, can you tell us a bit more about what you expect to hear from a risk and insurance presentation, and what you exactly need to make an informed decision.
Hello from me. Good evening to everybody. I would like to thank Pharma Committee and Laurent for inviting me here to talk to this workshop. So let's start. As a CFO and a member of the board, my number one priority is to survive in this new normal, although there is nothing new or normal about it. Like it or not, the euro area recession precipitated by the COVID-19 pandemic will be much greater than the financial crisis of the last 2 decades and will take time to recover from. So to ensure survival, I need to set A, financial objectives, that is, formulate a financial strategy, and B, translate it to action plans that are linked to particular or specific key performance indicators. And although different industries, as Kerry said, have different KPIs, and although KPIs change during crisis, I think the number one KPI, like Kerry said, is cash flow. Be it free cash flows, operating cash flows, or cash at bank, I think that it is and should be the number one KPI for every organization. And especially now that business funding is extremely tight and it's expected to stay that way for the foreseeable future. Now, apart from cash or cash flows, other KPIs may include debt covenants, which are ratios between balance sheet and P&L accounts. For example, debt over EBITDA, EBITDA over interest, total equity over total liabilities, current assets over current liabilities, and the last two parameters have to do with working capital, which is extremely important for companies like the one I work for, because imagine we need to hold 40% of our turnover as working capital. So imagine the Greek government, in order to help the companies that were hit by the pandemic, allow them to extend their payment terms by 60 days at the beginning and then by another 75 days. So imagine that extension, what was the impact to our cash flow. Now, returning to Laurent's question, I expect risk and insurance presentations, first of all, to address the exposure or the business impact of a particular risk to the above mentioned KPIs, and then to talk about the cost. And the simplest way to do this is to use a probabilistic approach to assess the exposure of a potential risk. That is, to adopt an expected value mindset and translate every single risk into probability and outcome terms. So, in terms of what I'm expecting to hear from the insurance or risk project owner are the following. First of all, I would like him or her to show me if it is worth mitigating that risk, because there are many risks that doesn't worth the time and effort to mitigate them. And the best way to see it is to see where that risk lies in the probability impact risk matrix. And my favorite tool to understand what is the qualitative aspect of every risk is to use the business situational framework of analysis, which divides a business into 4 categories, which is customer, product, company, and competition. I repeat, customer, product, company, and competition. And I would like to see what is the impact of a particular risk in each of these 4 branches, if there is any. Then I would like to see if the risk has a monetary loss or non-monetary loss. And the reason is monetary losses are easier to quantify. Non-monetary losses, especially those that affect compliance or reputation, are more difficult to quantify. Why? Because they affect expectations, and it's very important to manage expectations. Recent researches have shown that more than 50% of the value of companies comes from the so-called present value of growth opportunities in the valuation jargon. That is, comes from expectations. And if we do not succeed to manage expectations, we may see profit warnings, as Kerry said, and we may see the value of our stock drop. And if you don't believe me, take your favorite stock and try to reverse engineer it and find out how much, what is the part of this stock that comes from expectations. Then I would like to see what are the many aspects of risk. You know, we are, as human beings, risk averse, and we are keen to take action in order to avoid the loss. Cognitive psychologists have proved that the way we present risk matters. And my favorite terminology is to use a dragonfly eye view, like the super forecasters say, and analyze a particular risk from various perspectives. That is to build many scenarios, what can go wrong, and attach probabilities to each of these scenarios. Moreover, I would like to see what other companies are doing facing similar risk. I'm expecting the risk project owner to tap into the collective intelligence and bring me the best practices. But above all, I'm expecting the risk project owner to be able to factually back every single statement about risk. And let me give you an example. Let's say we have a company with 100 million turnover, and let's say that we would like to insure it for credit risk. And let's say that the risk premium is 1%. So we will have to pay within a year, let's say, 1% times 100 million, 1 million. And although the impact on, let's say, EBITDA, it's straightforward, 1 million, and the impact on cash or debt, it's again straightforward, 1 million cash, less cash, or 1 million more debt in terms of how we choose to financing it. It's more difficult to quantify what is the impact in the company value and some particular KPIs. And in order to do this, we have rate our clientele, and we have assigned them probabilities of default. And we have found what is the weighted average probability of default of our clientele, which is, let's say, 5%. 5%, in order to translate it to Standard & Poor's terminology, is something between BB plus and BBB minus. And if we multiply this 5% with our receivables, which let's say is 40% of turnover, 40 million, we end up with 2 million expected loss. And the impact of these 2 million in EBITDA is again straightforward, 2 million, and cash and debt. But the most important thing is, if we would like to translate this 2 million expected loss in the impact in the company, and if we use an enterprise value over EBITDA, a multiple of 8, and we multiply 2 times 8, 16, we end up directly with a hit of 16 million in enterprise value. And if we would like to convert it to equity value, we need to subtract 2 million less cash or add 2 million more debt. So it's 18 million hit in equity value. On the other hand, the hit of the cost of this premium is 8 times 1, 8 million, plus 1 million more debt or less 1 million more, less cash, it's 9 million. So this way, the communication of the risk proposal focus on the avoidance of loss, which outweighs the cost of the premium coverage. And although that was, I admit, a simple example, it shows a process. What is the process? How to translate exposure to financial KPI impact. And beware that sometimes a bad outcome outweighs a good probability. For example, the probability of a devastating loss, it's minimal. That means it is a good probability, but the outcome can be very bad. So I would expect the insurance or risk project owner to be able to present the rationale behind the expected value assumptions as clear as possible. And the reason is, we can only approve recommendations and give our consent only to things that we understand. We cannot approve something that we do not understand. And the same applies to me as a CFO and the BOD members.
Thank you, Michael. And I have to say, I like it when you say that your example is simple. I hope everyone has followed, but I got the logic, and if you allow me to share with you, because around credit insurance, for instance, it's always about let's say showing the value of the insurance product, and for instance for trade credit insurance, what I personally do is that I never really talk about the premium. I talk about the net cost, meaning premium minus the claims recovered. And then I match that with the number of clients that have been assessed by the credit insurance companies, the number of claims we have had, and the number of recoveries that have been managed by the insurance company, meaning that I show that credit insurance is a servicing product. It's not really a risk transfer product. And that you have a net cost of what is the net cost of your insurance product for what value. And the value is that basically we outsource the credit risk management of our customers, and we outsource the recoveries action that would cost us or lots of people, lots of resources, and lots of money. So your example is really good, I believe, in explaining how you should translate the insurance cost, meaning the insurance value compared to the value of the company. And my example is more about how do you translate that into what I call the hidden value. What is the real value of what we buy? It's not only about the premium and claims. That's really the underlying rationale of the insurance product.
I completely agree with you, Laurent. This is the whole idea. It's like, let's say, a service, but we have to discuss about the premium because, especially in Greece, we have badly hit the last, let's say, 10 years because we're running into a recession since 2009. So it's very crucial to convince BOD members in order to proceed with credit insurance. It is considered, let's say, a very delicate product that few companies can afford to buy it, let's say.
Okay. So thank you, gentlemen. I believe we have had very good very good explanations and from your various speeches about how to speak to executive and board members, all the question around KPIs and then about what the CFO is expecting in a risk and insurance presentation. So I believe it was a gradual way to get a better understanding about what we as insurance and risk manager should try to improve or develop in our communication strategy to the top management of our companies. Before moving to what we would call the pure Q&A session, with questions from the audience, I would suggest now that we go through what we call the polling question. So for the audience, let me just try to explain quickly. So you have this question, and we would love you to vote. So meaning to select one of these answers with the tool, on the platform, and we hope that it can bring us to interesting discussion between the panelists we have today. So the first question we would like to get your opinion on is about I just read it. Which of the following do you include when trying to gain commitment from executive management for risk management resources? So the choice number 1 is impact on financial metrics, 2, impact on non-financial metrics, 3, impact on company valuation, 4, others, and 5, do not know or do not use. So please, if you can just use your finger and click on the answer you would select, that would be great. And hopefully within the next 30 to 45 seconds, we will be able to share the result. Okay, so it seems the audience is not voting. I don't know if the tool is not working or if everyone is just sleeping. I hope this is not because of your speeches, gentlemen. let's try maybe with the next one. So please, if you are listening to us, it would be great if you could vote on this question: which of the following financial metrics your company uses to make decisions? 1 is EBITDA, 2 is debt, net debt, 3 cash flow, 4 valuation, and 5 you don't know. And if you don't want to answer because you don't know, just click on don't know, because it's already an information for us. So now you should be able to vote. Okay. So I really don't know what to do, because we have no answer. It's a bit frustrating. Not sure if it's because of the tool or if really no one is wanting to participate. That's a bit, the weakness of that kind of process. So maybe, gentlemen, we should try to answer these questions, between us. And for instance, Kerry, if I would turn to you, for that question, which of the following financial metrics your company use to make decision? I would say, from your experience, what would you say is the most commonly used metrics? And once again, how would you link that to risk and insurance in your communication to the top?
I think, as Michael said, he talks about cash flow. I talked about cash flow. I think that is the most important one. So if you're looking at the risk from a disruption that lasts over multiple months, multiple years, understanding the impact in terms of cash flow is critical. Also taking into account insurance recoveries and whether you get an upfront payment from your insurance company to tide you over that bad event. But I think that is critical, because Michael said, he, as a CFO, he doesn't want to be led by the conversation, right, we want to spend 2 million euros on this. He wants to understand what the exposure is, why he needs to address it, and then come along with the ask of the money. So I think the cash flow is the key one. But most companies are also managing that profitability. That's a key thing that's been communicated to shareholders, particularly earnings per share. So I would highlight those two: cash flow first, then earnings per share. Now, one thing I was interested to find out from the risk managers is, who is doing that? Is that part of their kind of toolkit at the moment when communicating with the board, or is that something they need to, some of the skills they need to develop and hone?
Okay. And sorry, thanks, Kerry, but now I just realize that I'm receiving lots of messages from the audience saying that the voting tool is not working, which is a bit reassuring for us, because we are sleeping or not interesting in the presentation. But it seems that everybody's asking, how can I vote? There is no vote option. I cannot click. It doesn't work. Jesus, there are many more comments than question. So okay, so we are going to manage. There is always a technical issue popping up at the point. So let's be practical and let's go. Maybe let's try to have to skip this polling question, because if the tool doesn't work, then it's not really relevant. And let's maybe try to launch the Q&A session. I don't know if we have. Let me just go back. So we have maybe we can start with the Q&A, because I think that time is running. So we have a couple of questions around this this communication to the top, and there are questions for Alessandro, I would say, if I try to summarize them. And it's around, from your perspective, what would be the main challenge in communicating to the board, because you have talked about that we need to present things that are actionable. So don't become, I would say, a reporting machine, just, always propose solution and action plan. But from the overall perspective, the feeling is that people believe, and they are not wrong, that when you go to the board or to the executive committee, you have 5 minutes, basically, or 2 or 5 or 10, depending on the topic, and if you are lucky and if they are interested. Global perspective, Alessandro, what and to question into one, what would be the you would think about in communicating to the very top?
Yeah, I think that this has been practically answered by Kerry and Michael. So the metrics are EBITDA, net financial position, stake values. So the values of the capital in the hand of shareholders, the reputation, the market expectation, the dividends. So all these kind of metrics are normally utilized in the reporting, and so a risks is a measure, is what measure the volatility which is incumbent on these metrics. But I would add also another point that could be interesting from, in particular, the insurance management, insurance manager community, which is a sustainability. Sustainability is more and more focusing in requiring quantitative analysis rather than qualitative analysis. And the insurance market in particular, all the main international insurers, and here we have Factory Mutual with us, are providing models for simulating the impact of various events over the time. So, for example, simulating the impact of sea level rise, simulating the impact of extreme weather event, simulating the impact of poor availability of water, and things like that. And I think that if we are able to communicate that we have the possibility to utilize these tools that are consolidated in the insurance market, and in particular on the largest insurers and the reinsurers, and are already utilized in their simulation, for example, for the Solvency II and their sustainability analysis, I think we are offering a very added value activities that can be recognized and put the insurance not to be the typical insurance that only the guy that is expert in insurance and the insurance is a cost, but is the way that the risk financing enters in the button rooms. I don't know if I answered enough to the question, but I wanted just to add a different perspective or a different on an additional point of view.
I mean, I believe it was clear. At least it was clear to me. So thank you very much. Thank you very much for that. I will try to get another question, and it's let's try to get that into one because we have a couple of questions. There are also question about how could we, and we have already a bit answered that question, but I would maybe ask Michael to elaborate a bit, how can we as insurance managers, we have understood that we have to focus on the KPIs of the company to try to translate that into let's call it the financial or strategic language from the top management. But very often we still see that insurance is really seen as a cost, and we have a lot to do to move our communication to the next level and apply everything we have just developed during this session. So maybe it's a combined question for Michael and Kerry. What would be your recommendation for risk and insurance manager to move that communication up? And basically the question is a bit tricky, but how do you remove the premium from the equation, and how do you keep the premium as a secondary item?
Shall I start?
Please.
I think what I have just mentioned is what I'm expecting the risk manager to do. Do not focus on the cost, on the premium. Focus on what is our strategy, what is the company strategy, what are the company targets, and how these targets may be affected by a particular risk. And if you do that, and you show that our financial strategy can be derailed by a particular risk, and to stop that risk, to cover that risk, we need only a fraction of the damage that can take place as a cost. I think this is just a cost-benefit analysis. Everything for me, it's a matter of cost-benefit analysis. What is the benefit of this? What would be the impact on our strategy, financial strategy, that amount? What will be the cost to cover it? A fraction of it, half of it, 1/10 of it, then let's do it. Otherwise, we may jeopardize our whole financial strategy. I don't know if Kerry would like to add.
The thing I would like to add is, in order to move away from the premium, the relationship between a company and an insurance company, as we heard in the plenary session, it's a risk management partnership of which the insurance coverage is one element. So identifying the risk and the vulnerabilities through site visits, as I mentioned, that's one part of it. Quantifying the interdependencies, as somebody also mentioned in the plenary session, supply chain exposures, that's all part of the risk management partnership. And then addressing them together. So, building that financial business case, highlighting the key exposures, and working through those things together. That's part of that risk management partnership. And also, FM Global's clients, the tenure tends to be very, very long. It's a long-term partnership. It isn't just about this year, next year. It's a 10, 20, 30, 50-year partnership. So that's how I would frame that discussion in terms of getting away from premium. Demonstrate that partnership in the past and going forwards.
Thank you, Kerry. Maybe I can take a last question from the audience, and we have a couple around. We always talk about, I would say, financial KPIs, quantitative analysis. So basically, numbers. And I would say this question is maybe more for Alessandro. That how would you recommend, or what would be your advice for risk manager also to move with the process itself? The point is, very often the risk is, of course, likelihood or probability multiplied by impact, but there is also a process, prevention, risk management, risk mitigation, that are physical, I would say, physical measures we have to take into our facilities, into the factories and everything. And is the board or the top management the best place to present, I would say, operational or improvement? If you have only 2 minutes or 5 minutes and you have to talk about KPI, so how can you influence the operation, the risk operation, of your organization, and what would be the best stakeholder to talk to about that within the company?
I fully agree with the comment and this question that I've read here in the chat. And by the way, I regard the friends that submitted it. But I would say in this way, in order to get the board attention, I need to present numbers and impact on numbers. This allows to get the attention and to get their requirement to the top management in doing something and to budgeting something to face a certain risk. And at that point, it starts the procedures and I would say the culture and the behavior of risks. So the board is declining a policy, is not managing it. Who is managing is the management. So in order to get the management keen and ready to approve, for example, budget and certain and the application of a certain procedure. For example, if we want to insert in the MBO parameters of certain managers a certain adequacy to risk indicator, this is a procedures. But to do this, I need a strong commitment to the top management or to the CEO and certainly from the HR director to have this applied. Who tell them to apply this is the board of director. So that's I would say, the various level that doesn't exclude the fact that a quantitative analysis is excluding procedures and behavior and risk culture. It's a way on how to stimulate it.
Thank you, Alessandro. I hope it's a satisfactory answer to the audience. So I believe it's now time to wrap up a bit, the key findings of this session and to get a kind of conclusion. So if we think about our starting point, we started with the idea that the insurance market hardening is a bit a difficulty for risk manager in the way they communicate to the top, because they are receiving other kind of questions from their top management, because simply they are bringing other types of news, let's say to the CFO or to the board, and basically we now have question around from the board saying what should we do? Should we pay more? Should we retain more? And of course, why? What can we do to avoid extra premium? Should not we just drop insurance? And why not? If we don't do that, how do you assess the risk exposure, and how do you explain to us, the board member or the executive manager, about the financial consequences, the impact on our KPIs, and what is the impact with or without insurance? So we have tricky questions that we were not really used to in the recent past. And I believe all our valuable speakers have explained that basically it is really about how do you explain the value of insurance? How do you translate the risk exposure and what does it mean to your board in terms of what is important for them and not important for you. So what are the consequences on the company, the value of the company, the financial targets, or any kind of other objectives the company may have. So it's really basically about being able to translate that into the language of the executive. So if I summarize that and I have noted, that we could have 5 kind of key principles. The first one is unlock the hidden value of insurance. Michael explained, how he would look at the value of credit insurance. That's really, if I understood you well, gentlemen, it's really the key. It's really show the real value in terms of economic impact or savings or protection. I mean, that insurance is bringing to the company, and not just only premium insured limit. And the potential claims. The second key principle I have mentioned is know the language. I would translate it that way, meaning you really have to first do your homework and understand what are the KPIs, what are the objectives, what are the strategic objectives, and what the board or the executive committee will look at and how they would like to hear from us, insurance and risk manager. The third key principle I would highlight, it's always to say that it's always about an outcome. It's not about a process. So it's not really about explaining what we do or how smart we are in developing our methodologies and techniques. It's really to deliver something that is helping the decision-making process. So we should always, once again, be humble. And don't try to give multiple details about our process methodologies, but really how can we give the management the information they need to make a proper, actionable, and concrete decision for supporting the business. And the fourth key principle, it is what I would call the pyramid of information, meaning that, when you go to the top, it's always about, you have multiple filters in a company. The information is coming from the ground and is filtered more and more to come to the top executive in a very, and sometimes incredibly summarized way. So how do you keep that meaningful? And we are back to the idea that, you have 2 minutes or 5 minutes, and you have to explain things that are sometimes incredibly complex, or have multiple sources of information, and that's your job to summarize it in an understandable way for the top executive. And for me, the pyramid of information is also around managing expectations. So really clearly explain the potential outcomes, be realistic and not too optimistic, but neither too pessimistic, because when you talk about risk, it's always easy to go to the extreme. But it's really about managing expectation, that there is no surprise, and they have the right level of information to make decision. So, gentlemen, before thanking you, these would be my key outcomes, or the key things I would take out of this session. And before saying goodbye to everyone, and of course thank you. Please, if you have anything to add in our conclusion, that's the time to make your own conclusion in maybe 15 or 30 seconds about this session, and the key message you would like the audience to bring back home.
Just from me, Laurent, quickly, as I just mentioned in answering one of your questions, it is a risk management partnership. You need to communicate that partnership, and that the insurance company is working with you to manage that risk together. That would be my conclusion.
My conclusion would be try to understand what is the strategy of your organization, how it translates to financial metrics, see what would be the impact on these metrics by any risk, and then focus on this impact.
My conclusion is enterprise risk management is a matter of strategic decision making. So we are offering an extraordinary methodology to take the right decision or a risk-based decision to the manager and to the board.
You and my conclusion will be to thank you all, gentlemen, for your valuable contribution to this session and to the seminar as a whole. So I really appreciated, the way we have prepared this session together, your insights, feedback, and concrete example. I hope the audience has enjoyed it as I did. So really, thank you all. Thank you very much for helping us to have what was, I believe, an interesting session. I hope the audience will take out of this, some theoretical but also very practical insight to help them to improve their daily communication process and to be more impactful. So I really hope you all have some ideas now, some focus point that you should try to leverage in your communication to the top. I also would like to say that we will be available in the networking lounge for any further discussion you would like to have with our panelists or with myself. Just to say once again, thank you to all our speakers. Thank you to the audience for joining us, and thank you to the Forma team for the logistic and the organization. I wish you all a very good afternoon, and I hope to see you also in the virtual drink or aperitif we should have later tonight. Thank you again. Take care and see you soon.
Bye.
Bye to all.